Silver at $76 an ounce sounds expensive until you understand one single number: 62, because when the gold to silver ratio resets to 62, history doesn't just suggest what comes next for silver, history practically screams it. And if you've been sitting on the sidelines wondering whether you missed the silver move, what I'm about to show you in the next few minutes is going to completely reframe how you think about where silver is right now and where it is almost certainly heading. Don't go anywhere, because this is the video that serious silver investors have been waiting for. Let's start with the foundation, because if you don't fully understand the gold to silver ratio, nothing else in this video will hit the way it needs to. The gold to silver ratio is one of the oldest and most closely watched metrics in all of investing. It tells you exactly how many ounces of silver it takes to buy 1 ounce of gold. That's it. Simple math. Right now, with gold sitting at roughly $4,700 an ounce and silver at $76, you divide 4,700 by 76 and you get approximately 62. That means it takes 62 ounces of silver to buy a single ounce of gold. Now here's what makes that number so significant and why every serious precious metals investor should be paying very close attention right now. Historically, throughout centuries of monetary history, the gold to silver ratio has averaged somewhere between 15 and 20 to 1. In the modern era, let's say the last 50 years of free-floating commodity markets, the ratio has averaged closer to 60 to 1. But here's the critical pattern that traders and analysts have tracked obsessively for decades. Every single time this ratio has pushed significantly above its long-term average and then reset back down toward the 60-65 range, every single time silver has subsequently gone on a powerful, explosive run that dramatically outperforms gold, every time, without exception in the modern data. So when you see the ratio resetting to 62 right now, you are watching a historical inflection point form in real time, and that is not something you want to ignore. Let's walk through what has happened at previous major ratio resets, because the data here is extraordinary. Back in 1991, the gold to silver ratio peaked above 100, meaning silver was historically cheap relative to gold. Over the following years, as the ratio normalized, silver massively outperformed. Then in 2003, the ratio was elevated and began compressing. Silver went on to run from under $5 an ounce to nearly $50 by 2011, a gain of nearly 900%. Gold also performed well in that period, but silver absolutely obliterated gold's returns percentage-wise. Then in March of 2020, the ratio hit an extraordinary peak above 120, the highest it had been in recorded modern history as the pandemic panic hammered silver. What followed was a silver surge from under $12 to nearly $30 in just a few months. Every major ratio reset has preceded a major silver outperformance cycle, and right now we are at another reset point. The reason this happens comes down to the fundamental nature of how these two metals move relative to each other. Gold tends to move first. Gold is the institutional central bank, sovereign wealth fund metal. When macro uncertainty rises, when inflation fears build, when geopolitical tensions escalate, when currency confidence erodes, gold moves first because it's the most liquid and most trusted store of value in the world. Central banks buy gold, large institutions move into gold, and all of that big, fast money pushes gold higher rapidly, which causes the ratio to spike. Silver gets left behind temporarily because silver's market is smaller, thinner, and slower to respond to macro signals at the institutional level. But then, and this is the critical second act, silver catches up. And when silver catches up, it doesn't just close the gap gently. It overshoots, because silver has something gold doesn't have: explosive industrial demand sitting underneath it. So when the macro environment has already been confirmed as bullish for precious metals, by gold's move, silver gets hit simultaneously by investment demand chasing the ratio compression and industrial demand from a growing global economy. That double engine is what drives silver's percentage gains so far above gold's during ratio compression phases, and that double engine is warming up right now. So let's talk about what a ratio compression from 62 back toward historical norms actually means for silver's price in dollar terms. This is the math that should make every silver investor sit up straight. If gold stays flat at $4,700 and the ratio compresses to 50, which would still be above the long-term historical average, silver would need to reach $94 an ounce. That's a 24% gain from current levels just to hit a ratio of 50, with gold going nowhere. If gold continues its own bull run and reaches $5,200, which multiple analysts consider entirely plausible given central bank buying trends, and the ratio compresses to 50, silver would be at $104 an ounce. If the ratio compresses all the way to 40, which has happened multiple times in history, including as recently as 2011, and gold is at $5,200, silver would be sitting at $130 an ounce. That's a potential gain of over 70% from where silver is right now, and that's not a bull case fantasy, that's a scenario grounded in historical precedent. Now I want to be honest with you here, because responsible investing requires honesty. The ratio compressing doesn't happen overnight, and it doesn't happen in a straight line. Silver is one of the most volatile assets you can own. It will have violent pullbacks along the way. There will be sessions where silver drops 3, 4, 5% in a single day, and the headlines will make it sound like the silver bull run is over. It won't be. Those dips are exactly what the ratio framework helps you navigate, because when you understand the macro structure, short-term volatility becomes opportunity rather than panic. If you've been finding this breakdown valuable, So far, please take 2 seconds and hit that like button and subscribe to this channel right now. We break down precious metals and macro investing with this level of depth every single week, and the community we're building here is genuinely one of the best in the financial space. Let's go deeper on why $76 silver is actually cheap, and I want to address this head on because I know what some of you are thinking. $76 an ounce sounds like a lot of money for silver. Not long ago, silver was at $20, $25, $30. How can $76 silver possibly be cheap? The answer is that price alone means absolutely nothing without context. A stock trading at $500 per share can be dirt cheap if the company earns $100 per share in profit. A stock trading at $5 per share can be wildly overpriced if the company is losing money and has no future. Price without context is just a number. What gives silver's price context is the ratio, the industrial demand story, the monetary environment, and the supply picture, and every single one of those factors right now is pointing in the same direction. Let's take the supply picture specifically, because this is a part of the silver story that doesn't get enough attention. Silver mine supply has been essentially flat for years. Primary silver mines where silver is the main product are becoming increasingly rare. Most silver today comes as a byproduct of mining other metals, like copper, zinc, and lead. That means silver supply is not really driven by silver's own price, it's driven by the demand for those other metals. Even when silver prices surge, you can't just flip a switch and produce dramatically more silver overnight. New mines take years to develop, permit, and build. So when demand surges, as it is doing right now from the solar and EV industries, supply cannot respond quickly. That structural supply constraint is one of the most powerful and underappreciated bullish forces in the silver market right now. The solar panel story alone deserves a moment of focus because the numbers are staggering. Modern solar panels use silver paste as a conductive material, and global solar installations are growing at an absolutely exponential pace. Industry analysts have projected that solar demand alone could consume amounts of silver that would represent a significant portion of total annual mine supply, and that demand is not going away. Governments around the world have made binding commitments to renewable energy targets. Solar is not a trend, it's infrastructure, and every solar panel installed anywhere on the planet contains silver. That is a structural, decade-long demand driver, sitting directly underneath the silver price, completely independent of anything the Fed does or doesn't do with interest rates. Now let's bring it all together: the ratio reset, the price targets, the supply constraints, the industrial demand, and talk about what actually comes next. The scenario that precious metals analysts are increasingly converging on is what some call a silver repricing event, not just a gradual drift higher, but a genuine market-wide recognition that silver has been structurally undervalued for years, and that the combination of monetary, industrial, and supply factors now makes that undervaluation unsustainable. When markets reprice an asset that has been undervalued for a long time, they don't do it gently. They do it fast, and they do it violently to the upside. That's the nature of markets that have been suppressed by one set of conditions suddenly being released by a new set of conditions. The timing signal for when this repricing accelerates is exactly what we talked about at the top of this video: the ratio reset. The ratio compressing back towards 62 from much higher levels is the early innings of that repricing. The historical pattern says the real acceleration comes when the ratio breaks below 60 and begins heading toward 50 and then 40. That's when the headlines start picking up silver, when retail investor attention floods in, when ETF inflows surge, and when the price moves that seem large from today's perspective start looking modest in the rearview mirror. Here's something else that very few people are talking about. Central banks, which have been aggressive buyers of gold for the past several years, are beginning to look at silver with increasing interest. Several emerging market central banks and sovereign wealth funds have started quietly adding silver exposure, not at the scale of gold, but the direction of travel is unmistakable. When central bank money starts moving into silver, even in small amounts, the effect on a market as thin and relatively illiquid as silver is dramatic. It's like trying to fill a small swimming pool with a fire hose. The price impact of institutional flows into silver is orders of magnitude greater than the same dollar amount flowing into gold, simply because the silver market is so much smaller. Let's also talk about the positioning picture in the futures market, because this is another critical signal. When the ratio is at elevated levels and then begins compressing, you typically see a shift in the commitment of traders. Report the COT report, where commercial hedgers begin reducing short positions and speculative money begins building long positions. That shift in futures market positioning is like the early tremors before an earthquake. The price hasn't moved dramatically yet, but the structural forces underneath are building. Watching the COT data for silver in the weeks ahead as the ratio continues to compress is going to be very telling about the pace and magnitude of the move to come. For investors who are thinking about how to actually position for this, whether through physical silver, silver ETFs, silver mining stocks, or some combination, the ratio framework gives you a powerful tool for ongoing decision making. As long as the ratio remains above 50, the historical evidence strongly suggests silver is still in the undervalued zone relative to gold and relative to its own long-term history. Every meaningful pullback in silver's price while the ratio stays elevated is, by the historical framework, a buying opportunity rather than a warning sign. The ratio is your North Star. It keeps you oriented when the day-to-day volatility tries to shake you out of your position. Mining stocks deserve a special mention here because they add leverage to the silver story in a way that physical silver and ETFs don't. When silver's price rises, a silver mining company's profit margins can expand dramatically because their costs are relatively fixed while their revenue per ounce surges. A silver miner producing silver at $20 per ounce in all-in costs makes $56 per ounce in profit at $76 silver. If silver goes to $104, that same miner makes $84 per ounce, a 50% increase in profit on a 37% increase in silver's price. That operating leverage is why silver mining stocks often move to 2-3 times the percentage of silver itself during strong bull runs. Of course, that leverage cuts both ways. Mining stocks are more volatile and carry additional operational risks, but for investors who understand what they own and have the conviction that comes from understanding the ratio framework, that leverage can be very powerful. The bottom line on everything we've covered today is this: silver at $76 is not expensive. It is cheap specifically because the gold to silver ratio has just reset to 62, and every time in modern market history that this reset has occurred, silver has gone on to dramatically outperform gold in the subsequent months and years. The industrial demand story from solar and EVs is structural and growing. The supply picture is constrained. The monetary environment with inflation concerns and eventual rate cut expectations favors hard assets, and the ratio math points to silver price targets of $94 to $130 or beyond depending on where gold goes and how far the ratio compresses. The setup doesn't get much cleaner than this. Drop a comment below right now and tell us what's your silver price target for the next 12 months? Are you in the $90 camp, the $100 camp, or are you one of the bold ones calling for something even higher? We want to know what you think, and the conversation in the comments is always incredible on this channel. And if you know someone who's been watching gold but sleeping on silver, someone who needs to understand the ratio story before this move really accelerates, share this video with them today. It might be the most valuable thing you send them all year. We'll see you in the next one.